All right, thank you for that. One more time, just want to have you guys type a Y in the room if you can hear my voice. Always good just to make sure everybody can hear before we get going. So I do appreciate everybody being here. My name is John Novak, and as Keith said, I've been involved in Fibonacci analysis and automation of the Fibonacci analysis since the 90s. And what I want to do in this webinar is take you guys through some of the basics of what we do and how we've used the bloodhound and how we've put things together over the years. First, just to kind of get into what we do, two main indicators that we use that we've developed over time: Fibonacci confluence. And Fibonacci confluence itself has thousands of pivots involved in it. And I know a lot of people are used to using, oh shoot, can you guys see my screen? Anyway, let's see if that worked. Can you guys see my screen okay? Just want to make sure. Okay, good. All right, scared me for a second there. So two things that we've done over the years that we've spent all of our time with. Number one, Fibonacci support and resistance. And number two, using our trigger lines to develop our trading plan based around Fibonacci support and resistance. Which areas are going to hold and which areas are going to break. And just to kind of give you guys some of the basics for Fibonacci, when you look at a chart, and really this is where I fell in love with Fibonacci in the beginning, because the guys that taught me Fibonacci back in the mid-90s said that Fibonacci is absolute. And what they meant by that is that Fibonacci projections and Fibonacci retracements only begin and end at pivot points. And the pivot points, if you think about it, the highs and lows in the market are representative of the exact price at which no person, no algorithm, no fund, no system, nobody on the planet was willing to buy or sell beyond that price. And again, when you use those prices with Fibonacci, bottom line, you guys normally that do Fibonacci will do Fibonacci from two swings, right? So you'll start down here at the bottom and you'll pull your retracement tool up, and then you'll look for different retracement areas. And, again, if you do Fibonacci at all, then Fibonacci works, but the trick to Fibonacci is which one is going to be the one that's going to cause the reversal. And, as you see in this slide here, if you measure from the bottom to the top, the 382 gives a bounce, the 618 gives a bounce, and then ultimately the 786 gives a reversal in the market. Why does two of them bounce and why does one of them reverse? That's always been the question that, we've asked since the beginning of time. One of the other things that we do, or our software does, is projections. Now, Fibonacci projections, and again, we're not going to drag this on for too long because we don't have to get into this too much, but Fibonacci projections are pretty simple. They take the high of the market and the low and then the first swing, and then they start using that range to project out into the future. So it's a combination of using retracements and projections, and you'll see that if you start at the top and use the first little swing to the downside, you can project 100% and it causes a bounce. 138% causes a bounce. And then ultimately 200% causes the reversal. Now, if you remember in the last slide, the 786 retracement caused the reversal, and the 200% projection caused the reversal in the market. All of the others just cause bounces. Now, if you do this from more levels, so let's say you take the first push down and then the second retracement level, then what happens is you get a bounce at the 100%, and then ultimately you get a reversal not at the 200 but the 161%. So what does that really mean? It means that all Fibonacci lines are going to cause bounces and not all of them are going to cause reversals. So the magic is trying to figure out which one consistently is going to cause the reversal. Now, this is the way most normal people that use Fibonacci do it. What we did is we took a bigger approach and we said, what would happen if you took 30 days worth of data? Whether it's a 1-minute chart or a 5-minute chart, doesn't really matter. You know, now we use range bar charts and we use these dynamic Rinkos or uni Rinkos or, you know, SI Pro Rinkos with the bloodhound. Everybody's got their own version of some range bound chart that they use. And, you know, these charts are really, really, really good at smoothing out the data so you can see the major pivots. But what we did with our software is we took, you know, and we're talking in the 90s, we still had a satellite dish out behind the house. In 1997, after learning how to do Fibonacci projections and retracements, what I wanted to do was create a software program. And the software program, it took almost 2 years to create the algorithm to generate a Fibonacci support and resistance, fully automated. Now, the software itself did every possible Fibonacci projection and every possible retracement over the given data set. And what we use normally is 30 days for our data set. Then what the software does is it creates higher time frames. So let's just say, for an example, you have a 1-minute chart. Well, the software would synthetically build a 3-minute, a 5-minute, an 8-minute, you know, and on. And we use the Fibonacci sequence for all of our time frames. So we use 5, we use 8, we use 21, we use 34. And what happens is we get every possible fib swing, projection, and retracement from 10 different time frames over 30 days worth. And essentially that's a lot of fibs, obviously. So we're going to take a look at that in just a second. But what we found is, and like we talked about in those slides, different projections caused different bounce levels. So we did a lot of study, or I did a lot of study on, does a 786 retracement bounce more, have more of an exhaustive quality than a 38% retracement? And, you know, over the course of my study, bigger is really better. The bigger the retracement or the bigger the projection, typically the bigger the bounce or full reversal. And so we set up a hierarchy so we could actually determine, you know, which ones were more important, which ones weren't. And then we also went through and we assigned a weighting hierarchy for time frames, because, you know, even with one chart, we're technically using 10 time frames worth of Fibonacci analysis. So there's two things that really stuck out. Number one, a bigger time frame, you know, let's say a daily 786 retracement was very powerful. But if you combine some of the smaller projections along with some of the larger retracements, you know, because what's happening now is important, but the big macro picture is also important as well. So what we did is we played around, and it took us a long time actually, to design the hierarchy for each of the time frames and the projections, so that way we could have the software calculate it for us and we didn't have to do any work. You know, and I have to go back, I guess, before we did software in 97, I taught a 4-day seminar. And in the 4-day seminar, we taught people how to do manual Fibonacci projections and how to do manual Fibonacci confluence areas. And it took 4 days and thousands of pulling on that tool to figure out where the confluence areas were. And that's really where I said, hey, software is going to be better. It's going to be more consistent. It's going to be more accurate. So finally, we developed an algorithm inside of the software that adjusted itself to the underlying market volatility. So what would happen is if the market became less volatile, then we'd start looking closer to the market for our key support and resistance areas. And if the market got more volatile, then the areas would dynamically spread out. So, in essence, what we've done is we've designed a software program that reads the market, adjusts itself to the market, and dynamically develops support and resistance based on the actual pivots that have really happened. And this is why our software, if you run it on Bitcoin, if you run it on crude oil, if you run it on Apple, S&P, gold, crude oil, everything, it works on every market because every market has its own dynamics, and the Fibonacci works consistently across all time frames and all markets. So what we had is ultimately the Fibonacci areas that would plot the highest concentrations in a small window of the most powerful fibs, and we call that, the confluence, if you will. I wanted to give you just a quick visual. Check it out. This was our software in its raw state in the 90s, before, the algorithms were applied to actually determine which area was support and resistance. So this is a 5-minute S&P chart from the 90s. And as you can see on the right side of the chart, if you actually plotted every single fib, projection, and retracement that's current, this is what you ended up with. So think about it. If you do manual Fibonacci projections, you're going to get something that's going to call a turn at some point. So what happens is, once we apply our algorithms to the software, this is what we actually end up with, and this is what our software basically crunches out of that. We develop a simple red or blue line that tells us where the highest concentration of support and resistance are. So this is from a single chart. So this is a 14-2 dynamic Renko chart. And again, a lot of people use this style chart. If you used a 5-minute chart, it'd be the same thing, support and resistance. A chart is a chart, and support and resistance is support and resistance. The trick is which one's going to hold and which one's going to break. So what we've done is, we typically use a few charts in our trading setups and what we teach people. And what we have done is we have superimposed, let's say this is a 14-2 chart, so we use a 21-3 chart. So what we've done is we've superimposed higher time frames and lower time frames or synthetic time frames onto one chart. Because what happens is, what you'll find, we've spent over 22 years doing this, so we're pretty good at it at this point. What you will find is that sometimes Fibonacci areas will hold and then sometimes they'll break, which is okay, right? I mean, if you really want to get technical, there's only one support area on the world that's going to hold, it's guaranteed forever. And that's if your commodity goes to zero. It will never go below zero. So, again, we don't want that to happen, of course. So, in the real world, what we do is, the markets are always evolving and they're moving. And what we need to do is we need to have some way to determine which areas are going to hold and which areas are going to break. And this is where we use our trigger line calculations. So again, our trigger lines are linear regression moving averages. They're not very tricky. Lots of people use these types of indicators or moving averages. And quite simply, what we've done is we've used a 20-period moving average. And we call this our small trigger lines. And, there's a 20-period and a 5-period average of that. And when they're crossed up, they're green. When they're crossed down, they're red. Very, very simple. Okay. Now, we've used also a little bigger version of the same indicator. And just to kind of give you the large trigger line multiplier, you can see it over here on the right. It's a 1.9 multiplier. Now, what does that mean? Well, it's the same trigger line indicator, but it uses 38 bars of data versus 20 bars. So again, it's the same indicator, it's just a little bit slower. So what we're doing is we're building a large trigger line and we're building a fast, slower trigger line, right? Bigger, slower. And then we go one step further. What we want to see is, and this is where we use all of our multiple time frame charts, is that we will actually plot a small trigger line from a really big chart, and we will superimpose that value on a smaller chart. And we name it a synthetic trigger. Synthetic fibs come from another chart, synthetic triggers come from another chart, and it's not tricky. It's a small trigger line from a large chart superimposed on a smaller chart. And again, you have to really keep in mind we've only spent 22 years perfecting this. So again, take it with a grain of salt that this is the best combination over 20 years that we've come up with. So when we look at a single chart, and then again, look, I'm going to show you how this fits in with what we've done with the bloodhound stuff as well. So just bear with me, I promise. When we look at a single chart, we have 3 trigger lines. They're all a small trigger line from the chart, small trigger line with a slightly bigger 38 bars, and then we have a small trigger line from a much larger chart, which gives us a synthetic trigger line. And what we do and what we teach, and we do this every day in a live class, is we talk about 2 things over and over: Fibonacci areas and trigger line configurations. And we have 3 different trigger line configurations that we use, and they will determine 2 trades that you'll take or 1 that you won't. You'll do trend trades when the triggers agree. You'll do counter trend trades or edge trades, if you will, when it says it's possible. And then there will be times where we'll do no trades. Now, here's what we did, okay? Since 1999, we've only had one goal: to make trading Fibonacci support and resistance as easy as possible. The Fibonacci algorithm that we use today, I want you to think about it. We wrote the algorithm in 99. We made the algorithm technically is exactly the same as it was in 99. So 20 years we've been using the same algorithm. The display, we used to draw boxes and did a couple other ways of drawing it, but in 2003 we solidified it, and what you see today is what we had in 2003. So we've been doing this for a long time. And now it's all about trend and counter trend trades, what's the tops or bottoms, and using the trigger lines. This is where we got introduced to Jeremy Tang and the Bloodhound, and really, obviously, my middle name is change. I love to experiment and I love to change, and I'm not afraid to change. And my personal motto is, if you're not doing something new, you're not getting better. So, I'm never afraid to change or test and test and test. And I think most of us in the day trading world all have that same thing. At some point, you have to go with what you have, but in 2012, we were introduced to the Bloodhound, and we went through months and months of testing. And again, this saves time, obviously, as you know. And since 2002, in our trading plan, our number 1 trade was a trend trade, and our number 2 trade was trading from the edges. So we got the Bloodhound. So what do you do when you get the Bloodhound? If you guys have had it, you all know you do the same thing. I did it too. Everybody gets to do the same thing. We want to create a fully automated algorithm that we could just turn on and generate free money, because we all love free money. So we'll just whip up a system and let it go, and everybody will be rich, right? Well, after our 5,000 attempts at creating the free money machine with the bloodhound, we realized, like most people do, you're probably not going to have exactly what you're looking for. And you have to keep in mind, we've already got 14 years of teaching fibs and triggers, and there's some nuances involved and some things that, we just couldn't quite get right. If you guys saw Daniel Rowe's presentation yesterday, he actually helped me. We wrote a bloodhound version that took 30 minutes to run. It was so complicated. Anyway, needless to say, we'll get to the next slide and you'll see where we ended up. What I did to simplify my life is I started focusing on the trigger lines and the bloodhound with the trigger lines. And, there's two routes you can go. You can program everything and then go test it, or you can actually test it with the bloodhound. And really, this is where the bloodhound, for me personally, was a godsend, because I like to experiment, but as you guys know, if you haven't used the bloodhound, you will, and if you've used it, it makes testing a lot of ideas visually very, very simple. And again, remember, we've only done 2 trades, main trades, since 2004. Number 1 trade was a trend trade, and number 2 was trading from the edges, and it's still true to this day. That's technically the only 2 trades that we have in our trading plan. We actually include today, even in our installers, we have a bloodhound template that we give for people that do have bloodhound. So it will do our 5-1 trend trades, and it will highlight them, and it has all the rules written out, everything else. We've written some super complicated versions that take 15 minutes to run. In the end, this is what we really ended up with. And, in trading, there's something called simplicity. And simplicity for us, at least with Nexgen, it's not for everybody, but we were able to take, after years and years and years of poking, take the bloodhound and finally test and program in what we feel is one of the most profitable versions of our trigger line reading that we've done with our fibs to date. And again, I have to go based on the thousands and thousands of clients that we have and the feedback that they give us on a daily basis on how consistent we are and the fibs are and the trades are when we have the right trigger line configuration. So again, this is where we spent the majority of our time. So again, we're going to circle back to fibs, but you have to understand when you can and when you can't. So we basically, through the bloodhound testing, came up with 3 looks that generate high probability trades. I'm talking 60, 70, 80, 90% of the time they win. And that's what you want, right? I mean, the holy grail in trading is not a software program. The holy grail in trading is confidence. Ultimate confidence. To know you're going to win most of the time, that's, in my opinion, the definition of the holy grail. So we had 3 looks. When the small triggers get below the other triggers, we call it a transition. And if we're in a transition and we have fibs, we can do a short trade. But we also have to manage our trades a certain way, which we won't get into today. And then if all 3 triggers are crossed down, we use our Fibonacci areas for super high probability number 1 look trades. And then when the trigger lines get inside of the other trigger lines, typically the market will start coming to an end. So for us, what we'll end up with is something like this. This is getting closer. So I drew in a fake resistance and a fake support on here, but we'll take trend trades with the trigger lines going up. We're basically buying pullbacks until we get to Fibonacci resistance. And if our trigger lines are weakening or inside when we reach Fibonacci resistance, they almost always reverse the market. And if we come off of resistance and we have a trigger line transition, we almost always end up with a winning trade to the downside. And then ultimately, when the trigger lines are inside of each other, Fibonacci support ends up holding. So again, we have three phases. We have trending, we have really, really strong, we have weakening, and then there's really a fourth one where the small triggers are in between both of the others, and this is where we typically end up with a range-bound market. And again, reading the trigger lines with our Fibonacci areas is going to give you the correct trade every time. You won't win every trade, but you're going to win most of them, and that's really what trading is all about. So again, number one, strong trigger lines. All the triggers are in the same direction. It's the best possible look. And again, when we have new traders that have never traded before, or maybe, they've traded unsuccessfully, we tend to keep people pointed in the direction of our strong number one look. Transition of trigger lines and then weakening of trigger lines. Weakening of trigger lines means we can do counter trend trades. And again, it's the same thing over and over and over. With the correct Fibonacci and trigger line reading, you will absolutely attack the markets with confidence. You will only do high probability trades that have 70 or 80% chance of winning. Every one of your trades is going to have the same look. And again, I think that's where a lot of traders have most of their difficulties is they play roulette with their trades, and they don't always have the exact same look. When you can do the same trade with the same look at the same area with the same triggers every single time, you'll have complete confidence. So again, when we talk about, and Damien, your risk reward for 60% winners, almost every trade makes 2 or 3 times what the risk is. So 60, 70% winners and making 2 or 3 times the profit that you were risking. So I'll take crude oil for an example, just to answer your question real quick. We'll start off with a max risk of $100. The average risk after we trail our stop ends up at $60. And usually $200 to $300 is what we make on every trade. So if you take average loss at 60 and average profit at 200, it's a little over 3 to 1. Now, if you don't read your fibs and triggers correctly, and again, this is where we run the live class, you'll see the new people read it wrong and they do losers, and then the older, more experienced people do it right and they've got winner after winner. When you read these things correctly, you'll do the right trade. So let's, take a look real quick. Again, when we talk about a transition, we're talking about trigger lines getting below. And again, we use the bloodhound initially to, test out all the background colors. And we've got everything really nailed down with the bloodhound. Obviously, we've hard coded it since then. But anyway, it's very visually simple to see. The small triggers must be below all of the other triggers, and then you're going to sell a pullback. So when we look at the right side of the chart, which is where the money's made or lost, we can see very clearly green background, small triggers above. If we get a pullback to the right spot, we're going to do a trade. Period. Right? So very simple. And what we're going to end up looking for, and again, this is a very, very typical look. And again, I want to show you this both ways because, it's easy to show everybody a bunch of winners and they go, wow, whatever. But, we don't ever shy away from losers. We want people to understand why you should or why you shouldn't take a trade and why you lost and why you shouldn't lose. So again, this is a transition look in our trigger lines, and this is where a bunch of Fibonacci support helps the position to go long. And again, look, this is how we typically start out. This is, $110, but the objective is to go up to the next resistance. So, again, if we make an up bar, we'll reduce the risk. It'll end up being about $60. Now, it's all in the fib and trigger line reading. If you have not reached resistance, and you are at support, you will do a trade 100% of the time. That's how easy it is. If you're at support and it is a transition, you'll do a trade 100% of the time, no matter what. Now, if you do the trade and the Fibonacci setup is wrong. So again, we have rules for what's right and what's wrong. Now, I cheated because I drew in the correct Fibonacci look just so you could see what a correct look is. This is what it really looked like. And you'll see the difference immediately. We're in a transition, but we have hit Fibonacci resistance at 57.49. And we have one simple rule that we have to have 4 triggers past resistance or we don't do a long trade. Because every time you get to fib resistance and you only have 1 trigger line passed, you're going to lose. So what happens is when you look at the chart, you can see triggers. And this, a lot of people go, well, I'm just going to make myself some triggers and then I'll be able to do the same trades, which is not the case. Because if you have the incorrect trigger lines with fibs, you're going to lose. When you have the correct trigger lines with the fibs, you're going to win most of the time. So what happens is, and again, we spend so much time doing this every single day in class. We've got it down to a science. The correct look will make a winner. If you do an incorrect look, you're going to end up with a loser almost every time. And the people who've had our software can attest to this. So winning is only about reading the fibs and triggers correctly. And when you read them incorrectly, your results are going to be awful. So when you read them and do it correctly, your results are going to be awesome. So again, this is where we focus all of our attention. Now, in a typical class, we actually use 3 charts. So we have a larger 14.2 chart, we have a medium 8.2 chart, and then we have a smaller 5.1 chart. And really what we're trying to do is we're trying to have synergy and we're trying to build the exact same look across all of our charts. So, again, if you look at the NASDAQ or Dow Jones or you trade Apple, weekly options, you might have to have a bigger chart than this, of course. But this is for futures trading where we spend most of our time. So, again, the idea is to have the right trigger line configuration on our big chart, which will determine whether we're going to do a trend trade or we're going to trade from the top or bottom. So let me show you what this looks like. On the 3 charts, we plot the same triggers. So on the 14.2 chart on the left, we've got a synthetic trigger. The same synthetic trigger is on the 8.2 chart, and the same synthetic trigger is on the 5.1 chart. So all 3 charts plot the same 24/6 trigger. Well, we're not calling trades, trader. I appreciate your question. We teach people how to do these trades and we teach people how to do this. We don't call trades for people. We teach you to do it. And, that's why we always free demo and spend time in there and you'll see it. If you take the time and spend a week with us, you'll see it. You won't need to be convinced. So once you get your trigger line's the same on all the charts. We also, 22 years, trader, of experience. Trust me, have no fear. I know what I'm talking about. I know nobody believes it until you do it. So just come do it and then you'll believe it. That's the only way to get around it. And again, it doesn't matter if 50 of my clients do it. You may be a rule breaker. So, again, I always tell everybody, come figure it out for yourself. If it's real, you'll see it. If it fits your personality, you'll want to do it. So, again, look, we will plot the same triggers on all of our charts. We also plot the same fibs. So, since we can plot synthetic fibs, all of the areas of support and resistance are going to be the same across the board. We use range charts with our volume analysis, Damien, which I'm not going to get into our market flow indicator here. It's too much, but for a short webinar, but I'm just giving you the basic overview. I have more information for you, which I'll share here at the end, okay? So here's what we want. High probability trend trade setups. Watch how simple this is, guys. We want to make sure that the large chart trigger line configuration is in one of the 3 looks we talked about. Transitioning from an area, number 1 strong look, or inside and weakening, but at support or resistance. Number 2, and again, I'll show you the next slide. This will make more sense to you, but you have to make sure before you put a trade on that you haven't run into what we call a termination spot, right? Because if you hit fib support that's supposed to hold, you don't want to go short anymore. If you have yet to hit fib support that's supposed to hold, you do want to go short. So again, we've got some conditions that will keep you from doing a trade. And again, we spent 20 years putting these conditions together, so we're pretty confident that in what's going to happen. So the idea for us is we want to buy a pullback to our areas when all of the charts say the same thing at the same time and all of our rules are met. So we want trigger lines helping the areas. We want fibs helping the areas. And again, let me show you this one slide real quick. This is page from our trading plan. And again, it kind of echoes the exact same thing that we talk about. Number 1, we need to have the correct trigger line look, and we have examples of each of these. Number 2, we want to make sure that we haven't hit something that's going to cause the trend to come to an end. So, again, I think this is where most people fail. They'll do something like, oh, I'm going to go copy Nexgen's trigger lines, and then they end up still not winning. And you'll see it's a really magical combination between the fibs and the triggers, and when you can and when you can't. And when you have one of these conditions, the triggers by themselves look like you're going to win, like that one slide I showed you. But when you put the fibs and the triggers together, you end up not winning. So ultimately, what we want is we want a synergy between the large chart not having hit a termination condition, and then number 3, we want all charts to agree. So look, this is what a very, very, very typical high probability trade for us looks like. It's obvious, very, very simple. We have a transition trigger on our 14-2 chart. We have red background on the 8-2, and we have our trigger lines crossed down and the small triggers below the other triggers. And then we have a pullback to Fibonacci resistance. So we're going to literally, think about this, trader, we're going to have a limit order waiting right there at that spot. So as the market's coming up into that area, we're going to be getting short, let's just say 57.59. And the minute the market makes a down bar, we're only going to have 30 or 40 bucks worth of risk. And then ultimately, we can see where the market is supposed to go to the next Fibonacci support. So again, every great high probability trade that we do and that we teach looks this obvious. It's going to have all 3 charts in agreement, all 3 areas in agreement, and we haven't yet hit the target. Very simple. And again, this is just one chart all by itself, but you see the process. It's a look, and it's the same look every single time. The triggers are going to be involved with the fibs, with the trend going down, and then we're going to get short, and you're going to be able to make 200 bucks. This one makes like 350. But, look, 200 bucks a couple times a day, and you're going to make plenty of money. Same thing's true on the long side. The look is going to be visually easy. That's the whole point, I think, about day trading. If you have the exact same look at the exact same spot and the exact same rules, and you can do the same thing over and over and over and over, you end up with winning trade after winning trade. And when you lose, that's okay too, but you're going to lose with a really high probability of winning. So, to go a little further, technically, some yes and some no. One of the shortcomings with the bloodhound for us is because we use synthetic triggers and fibs from other time frames, the bloodhound doesn't pick them up until after the fact. So, again, unfortunately, that's one of the shortcomings for us for the bloodhound and why we don't have everything programmed in there perfectly, because it can't see this synthetic trigger from a 24/6 chart until the next 24/6 bar, which is way up here. So we need that information over here, and unfortunately, that's one of the shortcomings in the bloodhound with our synthetic fibs and triggers. So technically, no. And that's why, again, once you learn what we do, you're not going to need it anyway. And again, it was great for us for testing. But in the end, as far as automation, we can't automate what we do because it just doesn't work properly. So anyway, didn't want to say anything bad about Bloodhound. It's just one of the shortcomings with our software. So here's what we got. We have Fibonacci resistance, okay? And watch how simple this is. If the triggers are physically above the other triggers, Fibonacci resistance will not hold. When the small triggers are inside of the other triggers and you're at Fibonacci resistance will hold. That's pretty simple, right? So if you get to a Fibonacci support and the triggers are below the other triggers, we're going to do another short trade until we get to support. And then we're not going to go long because we're not sure it's going to hold until the other triggers are inside of the large triggers. And this is the type of trade, those of you guys that know our trades, we'll get a pivot stop out at fibs and then we'll go long. So, again, just a visual for you. Watch how simple the visual is. Very strong number one trigger line look. We'll buy pullbacks to Fibonacci support areas on our smaller charts. And then when our small triggers get inside of the other triggers, which is what we call weakening, we check for Fibonacci support and resistance. So look, I put the two together. Again, these are real fibs, and I kind of superimposed everything together so you could see it together, just so you can get a good understanding of what we do. You get to resistance, it's not going to hold. When the triggers get past it, you're going to buy a pullback until you get to the next resistance. When you get to the next resistance, if the triggers are inside of each other, it's going to go the other way. Not my department, George. I'll let those guys answer that question. Some people use it, but I don't technically use it every day. We used it for developmental purposes to define, background colors and high probability trades, but I don't use it every day. So, not my department. You're going to have to work with the Bloodhound guys on that one. We've already used it and we've developed the rules, and that was years and years ago, and we don't technically use it today. So, does everybody understand this? Pretty straightforward, right? Triggers above, fibs break, buy a pullback, triggers inside, fibs hold. And again, that's the age-old question. Which ones are going to hold and which ones are going to break? So you get the same thing over here. This is where people that say, I'm going to get some trigger lines and see if I can get away with trading, end up doing the trade. So perfect example of a perfect transition look where if the resistance says it's okay, we'll go short. And when you superimpose on top of it, you'll see we end up with one of our what we call a termination condition. If we hit Fibonacci support and only one trigger line gets past it, it's going to go back up the other way. And again, we'd use this same logic over and over and over and over and over. Strong trigger lines down below the other triggers, we will sell pullbacks to Fibonacci resistance. Then when the triggers get inside, we check for Fibonacci support. And again, look what happened. We'll go short with, I guess you can't say immunity. You've always got risk in a trade, but very few times do we lose these types of trades. And then ultimately we go short and the target is Fibonacci support. And when we get to Fibonacci support, we know it's time to stop trading short because, the rest of the world doesn't know it's time to stop and we do. And that's why we don't do that last losing trend trade that most people do. And again, what's the old saying? If you've been around long enough, you know the saying, the trend is your friend until it ends. Well, we've spent 22 years perfecting exactly when it's going to end. So when we get triggers in between the two, so in between the large and the synthetic triggers, what do we get? We get what we call a range-bound look. And again, this is, stuff that we've studied over the years. And when we get a range-bound look, number one, you can't do trend trades. But if you have fibs at the edges, you can do counter trend trades. So what we end up with in a range-bound look is no trend trades, but having Fibonacci resistance at the edge, we can go short right here and make more money. And then we also use the trigger lines to define when a range-bound, sometimes it goes choppy for hours or days, and then sometimes it goes choppy for a short period of time. Range bound is over when all the triggers get back above again. Very, very simple. So again, you'll see the consistency at which we do this stuff. George, we do not do that because everybody does a different thing with different markets. With some people do trend trades, some people do counter trend trades, some people do both, some people do high probability. Everybody has a different version of it. My job is not to tell you what market to trade. My job is not to give you stats. My job is to teach you when you can take a trade. And my job is to teach you when you can't take a trade. And if you spend time doing it, you'll understand how high probability it is. Stats it's worthless. Because if you can't do it or you don't have the skill, you're not going to be successful. Can you do it? Do you follow rules? It's not about me, George. It's about you. I do trades in the class all day long. So we talk about the trade before it happens. We talk about the trigger lines before it happens. We put trades on in the class. So everything is fully exposed. There's nothing to hide. So look how easy, George. Strong number one triggers, you're going short. Triggers starting to weaken, you read your fibs, and then triggers coming together. Look what happens. This is the typical look of a day. Number one triggers wide, you're going short, you're going to make some money. Triggers get inside, but the fib resistance says you can do more short, you're going to go short again. And then ultimately, when you get to the last fib support, which we call edges, we have a slight overrun, but this is typically where we do counter trend trades to go the other way. Again, I'll let you go in and we'll read through the rules, but again, I want you to see the consistency at which we teach. Triggers get below, we'll go short. Triggers get inside, we'll stop going short. So watch, add the fibs to it. Triggers past the fibs, you're going short on a retracement. Target is Fibonacci support. When the triggers don't break support, we stop going short. When the triggers get past, we don't do longs either. We wait for one of two things to happen: the fib to change colors or the triggers to get back above the fib. Very simple. So I want you to think about, again, we do both. Trend trades are easy. Everything's going your way. You get a pullback to the triggers and the fibs. It's really, really simple. Counter trend trades, we do a little bit differently. We do what we call a retracement divergence, okay? And again, way back in the 2003, 2004, we used to use a MACD, and we did what was called divergence at tops or bottoms. And quite simply, it's just Fibonacci retracement levels. So if you take a Fibonacci retracement level in price and you look at it, it's a 786. And if you were to use our MACD indicator, which a lot of people have this now, they've all pretty much, since 2004, everybody's got one of these, but it's fine. Retracement at 50%, the market went 786, we end up with divergence. So, and again, you don't have to know this because our software will plot a negative number on top of the thing, on top of the bar and the pivot, and it will draw a line out to the right side. Okay? And what we will use this for is these are the exact entry prices at the top or bottom in our rules. So watch, here's our rules for a counter trend trade from the edges, from fibs. You must be at Fibonacci support or resistance. The trigger lines must be weakened and not in a strong look because you'll almost never win against really strong triggers. We have divergence that plots, and then we buy or sell a double top or a double bottom. Same trade every time. So look, this is out of our trading plan. This is exactly what a trade looks like for us. It's a counter trend trade. So we get to the edge of resistance, which is the red lines of fibs. We then wait for the software to generate this negative number up top. I don't know, can you guys see my pointer or not? I'm wondering if you can see my pointer at all. Anyway, up here at the top, we get a negative 91. That sets up the trade, and then what we do is we place a limit order at that magenta line. And when it retests that magenta line, if the trigger line configuration is correct, then we end up with a counter trend trade short. Only two things are going to happen. You're going to lose 10 ticks, and assuming crude oil, we watch crude oil as our main market, S&P, crude oil, and gold. But if you lose 10 ticks, you lose $100. And then if you get a down bar and you're in short from the pink line, then you're going to be risking $30 on one contract. And then ultimately, the objective is to make at least $200. In this case, obviously, it went down a lot further. Now, the rules are identical for the bottom. You have to reach multiple time frame Fibonacci support, the blue lines on your chart. You have to then have a divergence, which is this negative 74, and then you will place a limit order at that line. When the market retests the edges of fibs with divergence, you're going long. You'll lose 10 ticks if you lose, and you'll make a bunch if it wins. Those are our only two trades, guys. This trade from the top or bottom, and a trend trade in the middle if all the trigger lines are going your way. Very, very simple. So again, it goes back to fib and trigger line reading. When can you take which trade? If the trigger lines are above the other triggers, we're only doing trend trades. And then if the trigger lines are inside of the other triggers, which is what we call weakening, this is where we do our counter trend trades. And it's very, very consistent. Trend trades during pullbacks with strong triggers down win more often than lose. Pivot stop outs at fibs with the trigger lines inside end up winning more than they lose. And again, look, here's a real world example of what a trade looks like. Again, we have two red fibs on our charts, right? One from different time frames. And the first one has the wrong trigger line configuration. And if you try to sell here, you're going to lose. And then ultimately you hit the second fib and the trigger lines are inside. Let me see. I don't know where that is. Oops. Messing with my slides here. Laser pointer. There we go. Cool. All right. Laser pointer. Maybe a little late for that, but that's cool. You guys get the idea, right? Strong triggers at fibs, it's going to break. Triggers inside of the other triggers, what we're looking for is a pivot stop out. So look, and again, this is where a lot of traders end up doing the wrong trade in the beginning because they're like, oh, a fib and divergence, I'm going to go short right here. Technically, it didn't hurt you, but this is the correct trade. The edge of fibs with the weakened triggers, with divergence, with a retest, you're going short right there. And then ultimately, we're getting out, hopefully, with 200 bucks or more. And then if the trend changes, guess what happens? We do another one. Almost every time you get a really good counter trend trade from the top or bottom, you get a secondary trend trade and you make that money first. And then you get in here and you make that money second. It happens every day. Same thing over and over. So, again, when you get done with a day of trading, it's going to look something like this. This was from one of our classes. You're going to go long at the pivot stop out at the edge of fibs. Again, we went short at the edge of fibs with a pivot stop out, but we took our money off early because we weren't technically at the edge. And then we went short at the edge again with a pivot stop out, followed by that secondary trend trade that we talked about. Unfortunately, we got down to the edge of fibs and we didn't get the pullback we were looking for. So we ended up waiting for trend trades, and we got a couple trend trades along the way. This is a very, very typical look for how your trades will end up in a day. Traditionally, we get 6 to 10 trades per day that fit the rules. George, it's both. We do trades at the edges and we do trades with the trend. So there's technically 2 trades that we teach, one at the top and bottom and then one along the way. And you can use it for swing trading. You just trade bigger charts, same rules. So what we do, and really what we're doing and what we've done for all this time is we teach you first to read the triggers and the fibs properly so you know when it's okay to trade, not okay to trade. And then what we have our clients do is we have our clients simulate the trades in class, and we have them use something like Jing or Snagit with a screencast account and post their pictures in the class for feedback. So we can go over the rules and the trigger line rules, and did you get in right? Did you get out right? Did you manage your trades properly? So we go through, really it's more of a hand-holding educational class. And then what we tell everybody to do is to simplify the 2 trades and the plan for yourself. And ultimately it comes down to what fib and trigger line look are you going to commit to? Once you learn this fib and trigger line look is my best trade that I can do consistently, that I'm not scared to put on every single time, then you've got the right trade for yourself. And then what we tell people to do is not only simulate during the day, but then after the day, go back and download the replay data for that day and practice it again. And, essentially, look, if you trade perfectly, then you're going to be good, you're done. If you're not trading perfectly, we tell everybody to go back and retrade the day and fix any mistakes that you make, because you need you can't trade improperly, close your Ninja Trader down or whatever you use, and then come back the next day and think you're going to magically be a better trader. You have to actually trade and it's like Tom Brady practicing a play and doing it wrong and saying, perfect, let's go to the Super Bowl with this one. No, they do it over and over and over and over until they get it right. Because our trades are exact, the looks are always the same, and the areas are always the same, and the rules are always the same. The consistency, once you get it down, then, obviously you got it down. So you repeat this process every day until you're only taking the correct trades. You're not going to win every trade. You're going to take losers. We take losers every day in class. You won't be scared of losers anymore because you know most of your trades are going to win. And then we tell people, once you can guarantee yourself that you're going to be a winner, then it's time for you to go in and start trading live money. And what most people do is they trade and then they lose money and then they're not sure why, and then they kick too many things around. And again, trading consistently, and more importantly, I think trading confidently, knowing for sure that you have the right trade with the right look that wins more often than not, that's really what we're trying to get to. That's the grail, if you will. This is our live classroom, and we talk about different things. We run charts, we do trades before the trade happens, we talk about trades after they happen, we review everybody's work all day long, every day. And ultimately, this is the objective that we get everybody to that does the trades properly. Our objective is for you to be able to make $400 a day, every day, period. And if you can trade one gold or S&P or crude oil contract and you can guarantee yourself that you can make $400 a day, then obviously, what we always tell people, slow. I mean, think about it. Look, we tell people, learn, simulate, post pictures, do replay, take pictures, repeat it infinitely, however many times, until you guarantee yourself you're going to win. Once you can guarantee yourself that you can make money, then and only then do we tell people, look, start with $3,000 in your account. You don't need a bunch of money. If you can't turn $3,000 into 10 or 12 grand by the end of the month, you're not doing what we do properly. So if for some reason you lose $1,250, stop and start over. Because you should be able to take $3,000 if you do it properly and turn it into $500,000. And again, sometimes you have to lose, because there's always, you can see it in history, and then you can do it on the simulator, and then your butt puckers up in the real world and you make mistakes. So, our job is to help you work through those mistakes so you have the confidence so you can actually get to this spot. So again, simulator only until you can guarantee yourself that you can make money. This is why Trader and the other guys, it doesn't matter what anybody else does. If you can't do it, you're not going to make money. I'm 100% confident we can teach you to do it. We also spend a lot of time on management of trades, stops, targets, management, when to take profit, when to let things run. If you guys go to our website, nexgent3.com, you can watch everything. Look, we don't hide anything. You can download our plan. You can watch this video on all the indicators. You can watch this video about our trading plan. You can watch the trend trade rules, the management rules, the trading the edges rules, and then how to do market replay. Everything that you need to learn is right there, 100%. So anyway, go check that out. If you want, you can go to our YouTube page. I mean, I've got, I stopped at 5 years, but we've got 5 years of the same trades on there and thousands of them. So at some point, enough is enough, right? Once you get the right trades down, then you're off to the races. So again, I'll take questions. First of all, I appreciate you guys being here. We offer a free demo. We don't want your money. We just want some time. Let us prove to you what we do and what we teach and how it's going to help you. We'll get you NinjaTrader if you need it, full working software, live classroom. We'll give you feedback until you can't take it anymore, and then get to our website and go take a peek. I think you guys will like it. So, questions, comments, concerns, anything that you guys would like to go through before we're done? I appreciate you guys being here, first of all. But if there's anything specifically that you guys would like to go through, I'll be more than happy. Now's the time. If not, you guys enjoy your day. I appreciate you guys being here. We used TradeStation from the year 1996 until about 2006 or 7. So technically, we do have fibs and triggers for TradeStation, but we stopped any further development on TradeStation in 2007. They were very, very hard to work with. They didn't give free demos. They wouldn't help us write the bar structure. So we just decided to go another way with NinjaTrader. We're finishing up a version that will add some additional platforms later after our Ninja 8. But anyway, Ninja right now is the easiest one to use for everybody. Free demo, free software. Market replay, you can play around with the bloodhound. We include our bloodhound template in there so you can play with it and see, if it helps you, great. If you don't need it, great. Ultimately the idea is to make you guys confident in what you're doing. Check out the videos on our website, Andreas, and you'll see what we use. They all work. I could pull up Bitcoin on any time frame and it works. I could pull up Apple stock on any time frame, it works. Our fibs and triggers work perfectly on every market, every time frame. Soybeans, corn, Bitcoin, gold, no matter what you want to look at, it's going to work. So the real question is, what do you want to do? How much money do you want to make? Do you want a day trade? Do you want a swing trade? Do you want to get in and out in a couple hours and make a bunch of money? Or do you want to, have weekly option trades? It works on all of them. What we usually tell people, learn how to day trade with our software first, because you'll get more repetitions with the right looks. And then once you have the right looks, you can take that to a bigger chart. If there's no other questions, I definitely appreciate you guys being here. And I know that they were recording a version of this. I've got one recorded as well. So if you want to replay, feel free. Obviously, most of the videos that are on our website still have a lot of the same information on here. So take a peek at those. And no, we do 6-month lease or a lifetime version of the software. So, first question to answer is, can you make a ton of money with it? If the answer is yes, then everything else is inconsequential. FX, absolutely, Kurt, 100%. You want to trade Forex, it's the exact same rules, exact same trades, exact same reads, and it works like a freaking charm. You want to make 10 grand? Not a problem, Luis. Yeah, I mean, the trial is 10 days, even if you don't purchase. Look, if you watch our videos and you spend a week with our software and you don't get it, you probably shouldn't be day trading. That's the way I like to look at it. It's not for you, which is okay. I mean, I'd rather have you say, hey, that's not for me, than, buy software and not be happy. Yes, Kurt. We have 8 and 7. We're redoing our version of 8 right now. We've got a beta version of 8, but it was really written on the bones of our 12-year-old DLL, C plus DLL. So we're in the process. We're actually done. We're writing new deployment and security software for Ninja 8. Once that's done, probably in a few weeks, we'll be deploying another version. The difference between Ninja 8 and 7 for our software is negligible, because the fibs are the fibs are the fibs, and the triggers are still the same triggers. So the rules are still the same. So, Ninja 8's a nice newer platform, but as far as the rules and the results, nothing's going to change between 7 and 8. Good, Bill. That's exactly what we expect. If you're not going to buy, there's no reason for you to be on trial. We don't need tire kickers. We want people who are serious, and we don't have time to play around with people who aren't buying software. So, good. They did the right thing. Whenever you're ready to get serious, you let us know, and we'll be just as serious. Absolutely. The bloodhound templates are in the installers. They're on our website right now. You could run the installer and have the bloodhound template now without our software. So it's on there. Look, we're 100% transparent, guys. We want you to know what you're getting, know why you're getting it, know how it works, know if you can do it or not before you spend a penny, which I think is the only fair way to do it. You are going to guarantee yourself that you're going to be a winner. Who else would you trust other than yourself? Right? Makes sense if you say it slow. All right, guys. You guys enjoy your day. I appreciate you guys being here, and I look forward to answering any further questions. You guys feel free to email me or give me a call direct if you have any. No, it's more than that. $25,000, Lewis, is the cost of our lifetime software. And the answer is yes. It is worth every penny. But we do have a $5,000 for a 6-month lease option, which if you wanted to break it down by month, what is that, about 800 and something a month? Make $400 a day on one contract every day for a couple months, and you won't worry about the cost. You'll be more worried about the value. If anybody has any other questions, please feel free. Let me know. Yeah, only people that don't look at value, Lewis, say that, or people that are broke. So if you're not, that's like paying $250,000 for a Lamborghini. Some people would never do it because they'd rather just have a cheap Honda Civic. And, both of them will get you from A to B, but they're not the same. Trust me, I've had both. Yeah, and that's okay. Give us a call. Maybe we'll work something with you, okay? We're not totally mean, I promise you. Maybe we'll work something for you, okay? Special, since you were in here. I appreciate you. Now, if you're broke, you shouldn't be day trading. But if you got, 5 or 10,000 to play with, then we can talk. If you don't, that's okay too. All right, guys.